Good morning and welcome to Bulls, Bears, and the Bell weekend edition of the Deep Dive. So, if you're checking your portfolio this weekend, you are probably feeling, well, pretty good. Major U.S. indices just closed the week, ending October 24th, having decisively breached all-time high territory.
Yeah, optimism is definitely running rampant. You've got the AI story, which just won't quit. And maybe more importantly, we finally got some inflation data that looked, well, cooperative for the Fed.
Right. The first real sign maybe inflation is cooling. But here's the thing, this massive paradox we're facing going into the last week of October. This market looks strong on the surface, but the foundation feels like it's, actively cracking.
It really does. We're heading into what has to be the most packed, high-stakes 5 days of the year. All this confidence is running straight into a wall of risk factors.
And the market seems to know it, right? Volatility is up.
Oh, yeah. VIX, other indicators, already at 6-month highs before the week even starts.
Yeah.
This isn't just noise. This is the market hedging, actively hedging against three huge binary events, all hitting within, 72 hours.
Three major events.
Yeah, we're calling it the catalyst trifecta. It's a pretty dangerous mix.
Okay, so let's break that down. What are the three tests?
Okay, first, the Fed. Not just the rate cut, but a huge policy decision on liquidity, potentially seismic. Second, earnings, specifically the Magnificent Seven. It's judgment day for the tech giants that are holding this market up. And third, geopolitics, that U.S.-China summit. Literally a tariff cliff scenario. It's high stakes.
And if the market wants to keep climbing.
It needs the best case scenario on all three. All of them. No room for error.
And complicating all of this is the backdrop, right? The ongoing government shutdown, we're calling it the data fog.
Exactly. That's the perfect term for it. It makes everything uniquely challenging. Normally, you'd have your jobs reports, retail sales, fresh inflation data from the government, objective stuff.
But we're not getting those. Delayed.
We're flying blind, relying on, bits and pieces, historical trends, not real-time official data. And that lack of visibility, it's already pushing risk premiums higher. You can feel it.
So if the government data isn't there, the focus shifts completely. It falls onto corporate earnings, doesn't it?
100%. Those earnings calls, usually micro news, suddenly become our best, maybe our only, macroeconomic signal.
So CEO commentary becomes the macro data.
It's the only real-time, forward-looking data point we have. What they say about consumers, about supply chains, about hiring. That's what investors, and probably the Fed too, are going to latch on to.
Especially from the big guys, the Mag 7.
Oh, absolutely. Every word from those CEOs this week. It'll be parsed like a Powell press conference. The stakes are just that high because of this data vacuum.
Okay, so that sets the stage. Our mission for this deep dive: review the rally, then dissect the trifecta. Test 1, the FOMC and liquidity. Test 2, Apex earnings, the Mag 7 judgment day. Test 3, geopolitics and the tariff cliff. Let's start with the market action last week. How did we get to these highs?
Well, just looking at the numbers for the week ending the 24th, it was an absolute tear. Broke resistance, pushed into uncharted territory. It really was a powerful week. Lots of conviction. You saw weekly gains around 2% for the Dow, S&P 500, NASDAQ Composite. Usually takes weeks to get that kind of move.
And the Dow actually led slightly, over 47,000 for the first time.
Yeah, the blue chips were strong, up 2.2%. But the really crucial thing, I think.
It wasn't just tech this time.
Exactly. It wasn't just another narrow rally led by the giants. We saw broadening strength. That gives these highs a bit more credibility.
How so? Small caps.
Yeah, look at the Russell 2000. Small caps jumped 2.35%. That's key. Small caps are way more sensitive to the domestic economy, credit conditions, When they move up sharply with the big indices, it tells you capital is flowing more broadly. Investors are taking risks beyond just the mega cap tech names.
And the sector performance backs that up, right? Risk on was the clear theme.
Absolutely. You can see it clear as day. Money flowed into cyclicals and growth. Technology led, sure, up 2.77%. But industrials were right there, up 2.51%. That suggests bets on continued growth, manufacturing, logistics.
And defensively.
Dumped. Consumer defensive, down 0.66%. Utilities basically flat, down just 0.09%. The market was screaming, good news ahead, get invested. No hiding in safety place.
Okay, but why? Why this sudden conviction right before maybe the riskiest week of the year? What was the trigger?
It really boiled down to one specific data point that finally cut through that data fog. Inflation.
The delayed CPI report.
Yes, the September CPI finally released Friday, and it came in slightly cooler than expected. Headline and core both 3.0% year over year. Consensus was looking for 3.1%.
That 1/10% doesn't sound like much, but in this environment.
It's huge. It was the all-clear signal the market desperately wanted. It basically gave the Fed cover to pivot. It removes, or seems to remove, that sticky inflation hurdle, letting them shift focus to maybe protecting the job market, which has shown some other signs of weakness.
Okay, so the CPI beat was driver number one. What was number two?
Pure hope and rhetoric, really. The optimism trade around the Trump-Xi meeting confirmation.
Just the confirmation they would meet.
Yeah, the market jumped on that news. And then you had the rhetoric, President Trump talking about a fantastic deal coming. That just poured fuel on the fire. But here's the critical thing you need to remember. This is pure optimism.
Pricing in the absolute best outcome.
Totally. It's assuming a truce happens, so there's limited upside left if we get one, but it completely ignores the risk of failure. If talks collapse and those November 1st tariffs hit, that's not priced in at all. It's classic asymmetric risk. Dangerous setup.
We also saw some individual stocks reinforcing these themes, right?
We did. Little micro-proofs. AMD, for instance, surged 7.6%, new all-time high. That feeds the AI narrative, right? CapEx paying off.
That's big momentum going into the Mag 7 reports.
Definitely. And on the other side, you saw consumer staples like P&G edge up. Analysts took that as, okay, the consumer isn't totally broken, still buying necessities.
But it wasn't all smooth sailing. There was a reminder of company-specific risk.
Right, Alaska Air Group. ALK dropped 6%. Why? A big IT outage messed up their operations. It's just a reminder, even in a bull market, if a company messes up operationally, it still matters. Not every stock goes up.
All right, let's pivot to the first piece of the trifecta, the Fed meeting. Concludes Wednesday. Everyone talks about the rate cut, but you're saying that's just noise.
Yeah, I think that distinction is really crucial here. Look, the market widely expects a 25 basis point cut. Fed funds target down to 3.75, 4.0%. It's pretty much fully baked in now, especially after that CPI print. The justification is the softer inflation, the focus shifting to jobs.
So if they cut, the market basically yawns.
Pretty much. Now, if they don't cut, that would be a negative shock for sure. But still, I think secondary to the real story.
Which is quantitative tightening, QT. Explain why stopping QT right now would be such a big deal, such a bullish signal.
Okay, so QT, just quick reminder for everyone. Fed lets bonds mature off its balance sheet, doesn't reinvest, mechanically pulls money, liquidity out of the system. It's been this sort of invisible drag on markets for, over a year now?
How big a drag?
Potentially up to $95 billion a month. Massive. Now, why does stopping it now matter so much? Because for the past year, that drain was mostly absorbed by the reverse repo facility, the RRP.
The RRP, that's where money market funds park cash overnight with the Fed, like a buffer?
Exactly, a huge buffer. It soaked up the QT drain without really hurting the banks. But here's the problem. That RRP balance is dropping fast. It's well on its way to zero, as some analysts put it.
Okay, so the buffer is running out.
Right, and once it's gone, or close to gone, that $95 billion monthly drain has nowhere else to go. It starts pulling liquidity directly from commercial bank reserves.
And hitting bank reserves is the Fed's nightmare scenario.
Absolutely. Because of 2019, the repo crisis, they found out the hard way there's a minimum level of reserves needed for plumbing to work smoothly. When reserves dropped too low in 2019, overnight funding rates, like SOFR, went haywire. The whole system kind of seized up, forced the Fed into emergency action.
And we're seeing signs of stress now.
We are seeing some emerging stress in overnight funding. Little pressure's building. If they keep QT going and drain reserves further, they risk doing it again. A credit freeze, even a short one, is something they desperately want to avoid.
So ending QT isn't just easing policy, it's about preventing instability.
It's preemptive. It's the logical, necessary step to take before reserves get critically low. That's why the market wants it so badly. Stopping QT would stabilize the bond market, take pressure off long-term yields, and crucially for stocks, stop that $95 billion liquidity vacuum each month.
So if the rate cut is priced in, is ending QT also priced in?
No, definitely not fully. The market hopes for it, but it's still seen as maybe 50-50, a binary possibility. If Powell actually announces the end of QT this week, that's new information. That's a genuinely profound bullish signal. It releases liquidity, stabilizes the whole financial architecture.
So the market reaction Wednesday afternoon?
It hinges entirely on the QT announcement, not the rate cut. That's the signal to watch.
Okay, from the Fed's structural test to the fundamental test, corporate earnings. With the data fog, you call it earnings the macro oracle. What are investors looking for specifically?
Yeah, without reliable government data, management commentary is everything. Analysts are digging into three big themes in the Q&A sessions. First, consumer resilience. Hard evidence. Are people still spending? Trading down. What are the actual patterns? Second, Tariffs and trade. What's the real impact on margins, on pricing power? Especially crucial for Q4 guidance. And third, the billion-dollar, maybe trillion-dollar question for this rally. Is all that AI spending, the massive capex, actually hitting the bottom line yet, generating real revenue and profit growth?
And the pressure is immense because the whole market rally rests on this cracked foundation. Just those 7 huge companies, the Magnificent Seven.
The divergence inside the S&P 500 is just, well, it's staggering and frankly pretty dangerous. The index performance is almost entirely dependent on these giants keeping up their incredible growth pace.
What do the numbers look like for Q3 earnings growth?
Okay, estimates show the Mag 7 delivering year-over-year earnings growth around plus 15%. Really strong.
15% for the top 7. What about the other 493 companies in the S&P?
That's where you see the crack. The S&P 493. The rest of the market, they're expected to grow earnings at maybe plus 6.7% year over year, less than half the rate.
Wow. So the rally is incredibly narrow.
Extremely narrow. The whole index is basically hostage to these 7 stocks. And 5 of them report this week: Alphabet, Microsoft, Meta, Amazon, Apple.
Which sets up that asymmetric risk again. Expectations are sky high.
Price for perfection. Absolutely. Fueled by AI hype, valuations are stretched. If even one of these giants misses badly or gives weak guidance, the punishment will be immediate and probably severe. The other 493 just don't have the weight to stop an index-level correction if one of the leaders stumbles. It really is judgment day for the Mag 7. Hashtag C. Magnificent 7 previews. The dossiers.
Let's get into the specifics. Wednesday after the close, Alphabet and Microsoft. What's the focus for Alphabet? GOGL.
For Google, it's all about justifying that massive AI spend. We're talking maybe $100 billion in revenue this quarter. But the key is the AI capex guidance. Full year could be around $85 billion. Investors need proof this spending is driving growth, especially in Google Cloud. Estimates are for cloud growth around 29%. Needs to be accelerating, or at least holding steady.
And there's a risk with their core search business, too, from AI.
Yeah, it's nuanced. How are things like AI overviews impacting ad clicks? If AI answers questions too well, do users click fewer ads? That hits profitability in their main engine.
You also mentioned a key detail about their revenue number.
Yes, crucial for understanding profits. That big $100 billion revenue number you hear, that's usually gross revenue. What really matters for the core business margin is net sales, after they pay out traffic acquisition costs, or TAC, payments to Apple, others to be the default search. Net sales consensus is closer to $84.6 billion. If TAC comes in way higher than expected, it squeezes the profitability of that core ad business, even if gross revenue looks good.
Okay, on to Microsoft, MSFT, also Wednesday. What's the key metric there?
Azure. It's always Azure. Microsoft does a lot, but Azure is the growth engine, the star. Yeah. We're looking for growth around 38% year over year. But the real focus now is turning AI, specifically Copilot, into actual money. We saw those big contract signings, $23 billion. That's promising.
So moving from CapEx to revenue.
Exactly.
Yeah.
Investors need to see these AI services hitting the bottom line with good margins. The guidance on Copilot adoption rates. That's probably the single most important thing for their future growth story, which is built on enterprise AI.
Also Wednesday, Meta platforms. Meta, the big ad market proxy.
That's right. Meta gives us the best read on the overall health of digital advertising, which often leads the economy. Yeah. You have to look at the mix. Are ad impressions growing? Okay, but what's happening to the price per ad? If prices are falling, that suggests competition or weak demand, macro concerns.
And beyond ads, margins, and the metaverse.
Still huge focus points. Management discipline on operating margins needs to continue. And Reality Labs, the metaverse decision. Any hint that losses are accelerating or need way more capital, that could spook investors worried about cash flow for buybacks.
Thursday brings the giants, Amazon and Apple. Let's start with Amazon. AMZN, you said this might be the most important macro report of the week.
I think it is, especially because of the data fog. Amazon touches everyone, every part of consumer spending, from essentials to discretionary. AWS growth is always important, sure, maybe 14% expected, but the market will hang on management's words about the consumer, Q3 trends, holiday season outlook.
So Amazon becomes our substitute retail sales report.
And maybe unemployment report, too, in a way. What are they seeing in spending habits, trading down?
Yeah.
Inventory levels, delivery costs. Their commentary is the closest thing we'll get to a real-time pulse check on the U.S. consumer. If they sound cautious, it validates the Fed's dovishness, but could crush sentiment about corporate earnings. A real double-edged sword.
And finally, Apple, AAPL.
Apple's a bit different, more driven by its product cycles. The immediate focus. Early sales data for the new iPhone 17. How's it doing? Especially in China, that's a huge wild card. Beyond the phone, though, investors need to see continued strong growth in services, that high-margin subscription revenue stream.
Services are key to the long-term valuation story.
Absolutely. Predictable, high margin. If services growth slows down, it raises questions about the stickiness of the ecosystem and whether Apple deserves its premium valuation.
Okay, that covers the Mag 7. But other earnings matter too, right? For the rest of the market.
Definitely. Don't ignore the S&P 493 signals. Monday, you get cyclicals like Nucor for steel and industrial demand, Whirlpool for housing and durable goods. Their guidance is a gut check on the real economy. Then Friday, you wrap up with big oil, Exxon, Chevron, and big pharma like AbbVie. Gives you insight into commodities, global energy, healthcare spending, important pieces of the puzzle.
All right, the third leg of the trifecta. Purely binary risk, maybe. The U.S.-China trade meeting. Talk about brinkmanship.
It really is. That face-to-face meeting between Presidents Trump and Xi in South Korea on Thursday, October 30th, it's basically the last chance saloon before things get potentially very ugly.
Explain the tariff cliff again. What happens November 1st if there's no deal?
We see new heavy tariffs slapped on Chinese goods, reportedly 100% on top of existing ones, potentially pushing the total rate up to 155% on some things. If this meeting fails, those tariffs go live automatically November 1st. That's not a small adjustment. That's a massive shock to supply chains, to inflation, to the economy. Almost guarantees problems.
And China won't just take it. They've already signaled retaliation.
They've already acted, imposing export controls on rare earth metals. That's not symbolic. Rare earths are vital for U.S. tech phones, EVs, even military equipment. This isn't just about trade balances anymore. It's hitting strategic sectors. Economic warfare, essentially.
We talked about how the market is positioned for this. Dangerously optimistic.
Dangerously. The recent rally clearly shows the market priced in the fantastic deal rhetoric. It assumes success. A truce offers limited upside. The good news is already factored in. But failure, the imposition of those tariffs, that is absolutely not priced in. It would be a huge shock, confirming trade as maybe the biggest external threat to the bull market. Again, that asymmetric risk profile.
So the market hopes for a breakthrough, but what do the geopolitical experts, the think tanks like Brookings or CSIS, expect?
They're much more sober, much less optimistic. They see a real grand bargain solving all the deep issues like IP theft and market access as basically impossible in one meeting. Their view is neither leader is really ready to make major concessions to climb down. They see this summit more as just another step in an ongoing conflict, not a resolution.
So if a big deal is unlikely, what's the most probable outcome that avoids the immediate tariff cliff?
The most likely scenario, according to these experts, is something called a temporizing trade truce. Basically, buying time.
Kicking the can down the road.
Pretty much. They agree to keep talking, maybe set another deadline 60 or 90 days out, and push back the November 1st tariffs. It's a Band-Aid. It doesn't solve anything fundamental, but it avoids the immediate catastrophe. And for the market right now, avoiding catastrophe would probably count as a win.
Okay, even with the shutdown scrambling things, some key economic data is still coming out this week, and the Fed will be watching these closely.
Absolutely critical releases. These could either confirm the Fed's dovish narrative or completely blow it up. We have to watch them very carefully. First up, Tuesday, October 28th, Conference Board Consumer Confidence.
Why is this one so important right now, given the fog?
Well, it's one of our few timely reads on the consumer, since retail sales data is delayed. Specifically, analysts are watching the Expectations Index subcomponent. That measures how consumers feel about the short-term future. Historically, below 80 often signals recession, and it's been stuck below 80 since February.
So if it stays low?
It validates the Fed's worry about downside risks to the economy and jobs, justifying the pivot. But if it suddenly spikes up, say above 85, that muddies the waters significantly. Creates confusion.
Then Thursday, October 30th, a big one, advanced Q3 GDP.
Huge, not delayed. Our first official look at growth for the quarter that just ended. The consensus is around plus 2.9% annualized growth. The market reaction here is pretty clear-cut. A big miss, like 1.5% or lower. That screams slowdown, validates the Fed's easing stance. Probably bullish for bonds, maybe risk assets too if they focus on lower rates.
And a big beat, like 3.5% or higher.
That's tricky. Raises stagflation fears. Hot growth alongside sticky labor costs. Suggests the Fed might be pivoting too soon. That would likely hit bonds hard, push yields up, which is typically bad news for stocks, especially high-growth tech.
And Friday, October 31st, Halloween, we get two reports the Fed obsesses over, core PCE and the employment cost index.
Yeah, these are critical. Core PCE price index. That's the Fed's preferred inflation gauge. More important to them than the CPI we already got. It absolutely must confirm the cooling inflation story. We're looking for maybe 0.3% month over month. If it comes in hot, like 0.4% or higher, major negative surprise. Catastrophic, maybe? It would undermine the whole basis for the Fed's pivot. Very bad for both stocks and bonds.
And the employment cost index, the ECI.
Also crucial, it's the key wage inflation measure, not affected by the shutdown and seen as very reliable. Wage growth is the stickiest part of inflation for the Fed. If the Q3 ECI comes in hot, it signals labor market pressures are still intense, squeezing corporate margins, meaning the inflation fight isn't over. That could be the biggest potential bearish economic surprise of the week.
So putting it all together this week is just unprecedented, really. Market at all-time highs running on AI fumes and expectations of perfection across policy, earnings, and geopolitics.
Exactly. It's priced for a perfect landing on all fronts, and that expectation creates this huge asymmetric risk we started with. For this rally to even hold its ground, let alone continue, the catalyst trifecta needs to deliver 3 positive results. Back to back to back. Can't afford a single miss.
Walk through them one more time. What needs to happen?
Okay. The Fed needs to deliver that bullish surprise by ending QT. That's not fully priced in. The Mag 7 need to deliver strong results and strong guidance across the board. And the U.S.-China summit needs to deliver at least that temporizing truce to avoid the November tariffs.
That's a high bar. What happens if just one of those fails? A miss from Meta, Fed punts on QT, trade talks collapse.
Any single failure could be enough to shatter the narrative. It would immediately validate concerns about the narrow leadership, that cracked foundation, confirm it's a fatal flaw, not just temporary, that could easily prick the AI bubble, trigger a sharp, fast correction. Risk is repriced everywhere. You should really brace for some potentially extreme volatility, especially Wednesday afternoon through Friday's close.
And stepping back, that structural divergence Mag 7 earnings up 15%. The other 493 up maybe 6.7%. That's the big picture question, isn't it? It leaves you, the listener, with a provocative thought. What does it mean for building a portfolio long term if most of the market is growing so much slower than the very top? Is this concentration sustainable, or is it a sign of instability, something to really mull over?
Absolutely. For the immediate week ahead, though, focus intently on that liquidity signal from the Fed, the QT decision, and listen very closely to the consumer commentary, especially from Amazon. Those 2 factors, I think, will likely set the market's direction heading into November.
It's going to be a fascinating and potentially nerve-wracking week. A huge thank you for joining us for this deep dive into the Catalyst Trifecta. We'll catch you next time for more bulls, bears, and the bell.